about the taxes before we're going to transition to that. Like, how is that different tax-wise, like from any other investment? Like if somebody's having like multifamily, there's going to be different construction. Like tax-wise, how is it even looking like for a person? Like, how is the structure?
Right, and that therein lies the beauty of short-term rentals, because it's a completely passive activity, right? So on the surface, 100% of your expenses go into the loss column with this. And you think about it from a hospitality standpoint, and the two areas of taxes. It's either ordinary or it's necessary, right? But in the case where you're operating short-term rentals, and then more specifically in this business, you can have a guest that directly impacts your ability to make money if they show up and say, hey, there are no fried green tomatoes here, and there's not ESPN in the magazine or Netflix. They can then arbitrarily leave you a 1-star review that then directly impacts your ability to make money. So when you understand that the nature of this business from a hospitality standpoint, is it ordinary? Yes. Is it necessary? Absolutely it is, because I'm providing a guest experience. So when you think about that again, and you're building out a property, you understand, one, where the items that you're going to purchase that have a depreciation value, and then everything else that's going to add guest experience. But what we figured is really a price point for every investment we go into, and I'll say on average a three-bedroom home, we take somewhere between a $45,000 to $50,000 hit from a loss standpoint, just by opening a unit. And that's just an aggregated cost estimate over the course of a year across all the expenses. So all the utilities, some of your maintenance costs, your cleaning fees, everything you can throw into the bucket goes into the loss column. So we know going in, I'm going to take a $50,000 hit here. Now think about that when you do 20 or 25 properties in 12 months, right?
Yeah.
That becomes a pretty significant hit. And now, because you're doing a completely passive activity, some of that moves to from Schedule E to Schedule C. And all those Schedule C's tax differently. Schedule C losses help offset some of your taxable W-2 income. So understanding taxes and understanding business from that standpoint, if I give you in one scenario that the investor that doesn't understand taxes and they're not getting all their losses and everything's filed on Schedule E, versus an investor that does understand it and they're scaling because they understand losses mean from a tax perspective, and they're filed on Schedule C, and then you'll get two totally different investors operating in the same business, but one that's growing a business through taxes, and then another that's fumbling through the business.